While there are no shortage of risks globally and here at home, the TSX Composite Index is not far from all-time highs. Joining us now to discuss how to look for where things may go from here is Jennifer Nowski, Managing Director and Portfolio Manager with TD Asset Management. Great to have you back on the program as always, Jennifer. And yeah, we constantly talk about the risks. We see them in the headlines, but we take a look at the TSX Composite Index. We're not that far from, the best we've ever had in terms of where we're at. I'm rambling. Let's get to you. Where are the Canadian markets right now?
Yeah, so thanks for having me on. So actually coming into this year, the TSX had a couple tailwinds behind it in the form of better expected earnings growth and the positive impact of the Bank of Canada rate cuts. Now the big risk outstanding is the potential for US tariff changes. Now, as you alluded to, the TSX has been doing pretty well. In 2024, it was up nearly 22%, and that was led by the technology, financials, and commodities sector. Turning to 2025, the outlook for earnings on the TSX is actually positive. Earnings are expected to grow about 11% year over year this year. And that creates a kind of a positive backdrop for the market, because over the long term, if earnings are growing, it generally leads the stock market higher. Now, as we dig into the earnings growth and where it's expected to come from, it is actually fairly broad-based. It does vary a bit between sectors, of course. And one thing you have to consider with TSX earnings is they are, of course, influenced by commodities. And actually, though, if, say, spot gold prices were to stay at their elevated levels, that would be a positive contributor for the gold sector. They would generate some good growth this year. From a more macro perspective, as we know, the Bank of Canada has been cutting rates, and that'll serve to take some of the pressure off consumers and businesses and could lead to better economic activity later in the year. Now, in terms of valuation, yes, the multiple for the TSX has expanded over the past year. The forward multiple, or PE, is now sitting at around 15.5 times. That's about one turn or so above its long-run average. So it's still within range and not at an extreme level. Now, the big uncertainty facing the market right now is potential changes to U.S. tariff policy. Now, at this point, it's a very fluid situation. However, the ultimate outcome and impact of that is unknown.
All right, so we have this unknown that's hanging over us, and that's sort of a binary. One of your colleagues earlier in the week said binary situation. Either it happens or it doesn't happen. When we talk about that overhang of the tariff threat, how does that play out?
So I feel in general, whenever I talk about tariffs, that anything I say goes out of date fairly quickly. But at kind of a high level, the whole tariff negotiation creates two challenges for the market, because it creates uncertainty and then potentially lower GDP growth later on, depending on what happens. Now, it's taking the uncertainty piece of it. The market generally doesn't like uncertainty. It's hard to gauge what could potentially happen. But from a more real economic perspective, it also hinders businesses and consumers from making big decisions. So it could slow near-term growth. The other thing is it can distort, say, near-term earnings or economic data as people and businesses try to perhaps adjust their behaviors in anticipation, perhaps, of tariffs potentially coming. Now, the ultimate outcome is unknown, but if tariffs were implemented, the sizing, timing, extent, that'll determine the impact. It would be a negative for GDP growth in Canada and a headwind for the US too, because finding cost-effective substitutes for some imports isn't easy. It could be more costly. The other thing to bear in mind, though, is there are potential offsets to tariffs. So from a Canadian perspective, that might come in the form of a weaker Canadian dollar or additional fiscal and monetary policy supports. So certainly the tariff negotiations are a risk worth watching.
Let's talk about that weaker Canadian dollar, because obviously we have seen our currency pull back amid everything that's going on. How does Loonie weakness play into the Canadian investing landscape?
Yeah, so from a TSX or investing perspective, the weaker Canadian dollar basically supports exporters or companies that earn revenues in US dollars but have a cost basis in Canadian dollars. So if you look at the commodity players, commodity prices are priced in US dollars, so they earn US dollar revenue. And many of them that are listed on the TSX have their operations in Canada. So they benefit from the weaker Canadian dollar supporting their revenue side, all else being equal. The other impact is more of an accounting translation effect. So for businesses that have US operations and translate that income back into Canadian dollars. So that's in areas like technology, some financials or industrials. Now the businesses that have more of a challenge are those that are importing goods from the US So for example, grocers might face higher costs, and they'll have to manage how they purchase and how they pass that through the consumer. Now, one thing to bear in mind is that often companies have hedging programs, so in the near term, some of this doesn't maybe flow through quite as expected or as quickly.
Okay, when people think about the Canadian market, and that's what we're talking about here, they think about dividend players. Let's talk about the performance of some of the higher dividend yielding stocks. What are you seeing out there?
Yeah, so 2024 was fairly good for the higher dividend yielding sectors, with the financials and pipelines actually outperforming the TSX. Utilities and REITs also generated positive returns, but the real laggard was telecom. Now, if we take a look at how dividend yielders performed throughout the year, things generally really picked up in the summer. And that's after we had the initial Bank of Canada rate cuts, and then it was becoming apparent that the Fed was going to cut rates too. So the stocks kind of rallied through the fall, and then I'd say kind of leveled out near year end, and that's because the 10-year yield, which fell initially with the rate cuts, kind of rebounded and has been perhaps stickier. So when we think about the valuation for the dividend yielders, looking at the direction of that 10-year yield will be a kind of key influence through 2025. Now, I'll dive into kind of two sectors, the laggard and one of the leaders. So starting with the laggard, and that was telecom, which was down during the year. And really, it was more of an industry issue with heightened competition pressuring prices. That made revenue growth negligible. Looking forward, there's some concerns that with slower population growth in Canada this year might be a more challenging environment. While there might be some early signs that pricing is stabilizing, it's still something that investors are watching carefully, and we need to see that sustained for longer. The other concern is more stock specific within the sector. Some of the players do have to lower their leverage, and investors want to see more progress on that. One thing they could do potentially is sell assets, for example. The one area that did much better, though, was the pipelines and midstream sector, and that was a benefit of rates, but also a better macro environment in that industry. You know, oil prices were range bound, but that was been a healthy environment for their producer customers. Many of them have hit or near their leverage targets and are in a good position to kind of fund some modest growth. And there is modest growth opportunities for them, in particularly connecting LNG facilities with gas supply, as well as providing gas supply for growing power demand, as well as some of the renewables growth that these companies have.